President Trump recently made an announcement that's getting a lot of attention. He just declared a national emergency related to Cuba. This is a fascinating topic, and I've discussed all the important updates in a new post, including the Russia and China factors within this escalation. I think you should definitely check it out. It's a free post, so you're welcome to read it and share it. Thank you so much for joining me today. I'm so glad you're here. Please make sure you're subscribed to Newsix Brief. For months now, we've been told a very simple story. The tariffs are back, and America is finally getting tough. The trade deficit is being crushed, factories are coming home, and the trade imbalance is being fixed. Well, here's the problem with that narrative. A trade deficit is not actually an issue. It's simply not a problem for a country to have a trade deficit. In this video, I'm going to explain why the latest headlines are meant to deceive you, distract you, and misinform you. The information I'm about to share will help you understand one of the most important economic indicators. I'll probably write more about this on my Substack or Patreon to dive even deeper into this topic because it's incredibly important. First, let's quickly run through the recent numbers that are officially available as of today. For comparison purposes, in October, the U.S. trade deficit sat at just over $29 billion, which was the lowest level since early 2009. This was held up as proof that the tariff regime was working. But 1 month later, in November, the deficit didn't just rise. It nearly doubled, exploding to almost $57 billion. That's a 94% jump in a single month. A 94% jump in just 31 days. And economists weren't even expecting this. They weren't even close. Forecasts were blown out of the water. Exports fell by nearly 4%, and imports surged by 5%. The gap widened fast, and it widened most sharply with America's largest trading partner, the European Union. The U.S. goods deficit with the EU jumped from under $8 billion in October to roughly $14 billion in November. About 1/3 of the entire surge in the trade deficit came from Europe alone. This is happening despite, and more accurately because of the tariff agenda and the US-EU escalations. And that's where the story gets really interesting. A trade deficit is not an economic failure. It does not mean the US economy is collapsing. It simply doesn't mean that. It's not proof that a country is being ripped off, which is what President Trump loves to say. And it's not, by itself, evidence of economic weakness. That framing is completely wrong. A trade deficit simply means that the United States imports more goods and services than it exports. That's it. It doesn't mean America is losing money the way a household would in this scenario. Countries are not households. They don't settle trade accounts with a credit card bill at the end of the month. So when you look at these month-over-month fluctuations, don't get distracted. Don't overdramatize the numbers. What actually matters is what we're importing, what we're exporting, and pay close attention here. What happens to the dollars that flow abroad? In other words, capital flows matter more than a deficit or surplus reading at any given point in time. Here's the main takeaway I want you to remember from this video. When the United States runs a trade deficit, foreigners don't take those dollars and bury them in the ground somewhere. They recycle them back into the American financial system. That is how the entire world actually supports the US economy, and it has been going on for decades. They buy US treasuries. They invest in stocks. They purchase real estate. They fund companies and their expansion. They provide capital. The trade deficit is the mirror image of a capital surplus. Those capital inflows help keep US interest rates lower than they would otherwise be. They finance government borrowing. They support asset prices. They fund innovation and expansion, as I mentioned earlier. And that is not a bug of the system by any stretch of the imagination. It's how the system is designed to work. There's also the reserve currency reality that almost no one wants to talk about. Honestly, the world runs on US dollars. Global trade, energy markets, debt markets, financial plumbing. All of those things require a steady supply of dollar liquidity. Now, you might ask me, but you're always talking about de-dollarization. Yes, the US dollar is slowly but surely losing its global dominance status. But as of now, it's still the reserve currency of the world. That's a fact. Currency multipolarity has been accelerating. Why? Because Washington weaponizes its currency. But the dollar is still in demand. That's just a fact. And what's important to remember is that the only way the rest of the world can get those dollars is if the United States runs persistent deficits. If the United States suddenly balances trade, global liquidity would shrink financial stress would rise, and capital markets would tighten. That would not be a victory by any stretch of the imagination. It would be a shock, and nobody can afford that kind of shock right now. In other words, trade deficits are a symptom, not a verdict. They reflect high domestic consumption. They reflect strong demand. They reflect a currency the world still wants to hold and an economy that attracts capital. None of that means there are no downsides. Of course, certain industries do lose out. Workers in those exposed sectors and industries bear real costs. Supply chain dependence creates vulnerabilities. These are legitimate concerns. But trying to fix all of that with blunt tariffs is like trying to repair a watch with a hammer. I think that's a great metaphor to show you how silly that idea is. What the November data really shows is volatility. That 94% increase is volatility. And I'll explain in a second why it certainly doesn't show that the US economy is about to collapse. Back in April 2025, when the White House declared a national emergency over the trade deficit and announced the so-called reciprocal tariffs at that Rose Garden event, the deficit itself was used as the justification. But as the year went on, reality forced adjustments. The framework agreement with the European Union in August capped tariffs at 14% on most goods, not because deficits disappeared, but because the instability was becoming too costly. The November surge is the delayed echo of those decisions working their way through the system. That's all there is in a nutshell. So at this point, you might ask, well, if the trade deficit isn't the villain it's made out to be, what's the real issue here? The real questions are based on domestic issues. I would say those questions are capital inflows being used productively, or are they inflating asset bubbles? That would be the first question to ask. And if you've been regularly watching my videos, then you already know the answer to that question. The next question to ask would be, are tariff-driven price increases hurting consumers more than they help producers? I also answered that question just last week in a recent video. Are supply chains being diversified enough? Or are they just being made more expensive? Economist Michael Hudson answered that question in a recent interview that I uploaded last week. Another relevant question is, are we strengthening long-term industrial capacity, or are we just reshuffling trade flows on paper? I would argue it's the latter. These questions matter far more than whether a monthly deficit print goes up or down. That 94% increase should not be taken out of context. The obsession with the headline number misses the point. Trade balances don't tell you who's winning or who's losing. They tell you how money, goods, and capital are moving through a global system that doesn't bend easily to political narratives. November's nearly doubled deficit isn't a failure of America. It's a reminder that tariffs don't override economic gravity, and whoever wants to impose a very rigid protectionist regime should account for the real economic data. Tariffs actually redirect that process in ways that are harder to control and more expensive than advertised in the very beginning. Until this reality is acknowledged, the trade deficit will keep surprising people who think it's supposed to behave like a scoreboard. Now, let me add something crucial that ties all of this together. Understanding trade deficits correctly is essential for making sense of the larger economic picture we're facing. The narrative that equates trade deficits with national weakness is not just misleading, it's dangerously simplistic. It reduces complex global financial flows to a single number that, when viewed in isolation, tells us almost nothing about economic health or prosperity. What we're witnessing right now is a fundamental misunderstanding of how modern economies function in an interconnected world. The focus on month-to-month deficit numbers creates political theater while obscuring the real structural challenges we face. Productivity growth, infrastructure investment, workforce development, and intelligent capital allocation. These are the metrics that actually determine long-term economic competitiveness, not whether we import slightly more than we export in any given month. The volatility we're seeing, that dramatic 94% swing, is actually evidence that tariff policy is creating instability rather than strength. When policy tools are mismatched to the problems they're supposed to solve, you get exactly this kind of whiplash. Markets respond. Supply chains adapt. Companies find workarounds. And the numbers bounce wildly because the underlying economic forces haven't changed. They've just been temporarily disrupted. The irony is that the countries being targeted with tariffs, particularly the European Union in this case, are often the same allies whose investment in US assets helps keep our economy running smoothly. When we view them purely as adversaries in a zero-sum trade game, we risk damaging the very capital flows that benefit American consumers, businesses, and the government itself. This is why economic literacy matters so much right now. When leaders present trade deficits as scoreboards and promise quick fixes through aggressive tariff regimes, we need to understand the fuller picture. We need to ask better questions about where our economy is headed and whether the solutions being offered actually address the real problems. The data is telling us a clear story. We just need to be willing to listen to what it's actually saying rather than what we want it to say. Thank you very much for watching. I hope this video was interesting and that you learned something from it. Make sure you support my work if you like this content. Thank you so much, and I look forward to seeing you all here tomorrow on Newsix Brief. Take care.